Okay, let's unpack this. We are diving deep into the recent release from General Motors, their Q3 2025 earnings call materials, the investor docs. And look, if you just saw the headlines, you'd think, wow, amazing success story. They raised their full-year guidance significantly.
Right. It looks like a huge financial win just on the surface. But when you dig into those documents, it reveals a much more complex picture, frankly, a really expensive story playing out underneath those headline numbers.
Yeah.
So our mission here really is to dissect this massive strategic pivot GM is making. They're fundamentally, right-sizing their future right now, which means making these dramatic, almost opposing moves on EVs, on internal combustion engines, and dealing with global trade stuff like tariffs.
And here's where it gets really interesting for you, the listener. Think about this. How does a huge legacy automaker like GM absorb a major operational charge? We're talking $1 billion plus hit to basically dismantle some of their planned EV manufacturing capacity, while at the same time feeling so confident they raised their financial forecasts for the whole year, and they even project 2026 will be even better. That contradiction, that's really the core of this deep dive.
It really is. It's almost the definition of leveraging today's strength, the current profitability, to correct for yesterday's strategic, maybe overreach. They're using the sheer profitability of their legacy business, the trucks, the SUVs, the cash cow, to buy themselves time and aggressively fix those earlier EV capacity forecasts that just proved way too ambitious.
Okay, so let's start with the foundation then, the money. The Q3 performance itself was genuinely pretty strong.
Yeah.
The first key figure that jumps out is the core operating profit.
Yeah.
EBIT adjusted came in at $3.4 billion.
Yeah.
And just for anyone unfamiliar, EBIT adjusted, that's basically the company's operating income before you account for those big one-time strategic charges we're going to talk about.
Exactly. And that financial foundation, it's really built on market leadership. They hit, 17.0% U.S. market share in Q3,
Wow.
which is their highest Q3 share since 2017. That's a serious comeback story for their core brands, traditional vehicles.
But the real marker of financial health, sometimes it isn't just how many cars they sold, right? It's how they sold them. Expert maybe talk about their pricing discipline.
Absolutely. This is the indicator I always look for. Their Q3 U.S. incentives were only 4.0% of the average transaction price, the ATP.
Only 4%.
Yeah. Now, contrast that with the industry average, which was way up at 6.9%.
Huge difference.
Huge difference. It means they're selling vehicles based on the strength of the product, based on high demand. They're not just relying on deep discounts to, move metal. That tells you the market really wants what they're currently building.
And that operational muscle, that pricing power, that's exactly why they felt comfortable raising their full year 2025 guidance. They raised both ends of the range. Now they're expecting EBIT adjusted between $12.0 billion and $13.0 billion. And they also raised the target for adjusted automotive free cash flow up to $10.0 billion to $11.0 billion. I mean, those are massive numbers.
They really are. And raising targets like that is phenomenal, especially, like you said, given the friction they're dealing with from tariffs globally. GM's stated top priority, they keep saying this, it remains restoring North American EBIT adjusted margins back to that historical 8% to 10% range over time.
Okay, but their North American margins were 6.2% in Q3. Sounds kind of low compared to that 8 to 10% target. Did management address that gap directly?
They did, and they offered a really crucial clarification. Management estimates that if you were to exclude the massive external impacts, specifically the costs tied to tariffs and also some higher warranty issues they had, then the North American margins would have been around 9%,
Yeah, okay.
which puts the underlying profitability right back in their historical sweet spot.
Right.
And that insight, that underlying strength, that's why they can look ahead and confidently project that 2026 will be even better than 2025. They feel they have concrete levers, like reducing that warranty exposure and maybe most critically, dramatically cutting the losses from the EV side of the business.
Okay, let's talk about that EV correction.
Yeah.
Because this is where the narrative gets, well, truly paradoxical, doesn't it? GM is now stating pretty frankly that near-term EV adoption will be much lower than planned. But, calling it operational agility kind of sounds like corporate spin for, oops, we completely misjudged the market. Was the original capacity planning really that flawed? Or did external factors just kind of break the model?
Well, it was probably a combination, but the biggest trigger, it seems, was the immediate collapse, or maybe near collapse, of the regulatory and incentive environment. You see, Q3 saw a record 67,000 EV sales for them, which sounds great.
Yeah.
But management admitted that was largely demand being pulled forward right before those federal consumer purchase incentives just vanished.
The cliff effect.
Exactly. And then October demand, post-incentives, it softened dramatically. So that just swings the whole calculus of future manufacturing needs.
And that swing forced them to take pretty serious and expensive action. They recorded that substantial $1.6 billion special item charge in Q3, all related to realigning their EV capacity away from those overly optimistic forecasts.
Yeah, and in this charge, it really represents a ruthless prioritization of capital. $1.2 billion of that charge was non-cash impairments. So this isn't just shuffling some assets around on paper. This is GM formally declaring several costly long-term bets from the last few years basically dead.
Oh.
It relates to pivoting the Orion assembly plant away from EV production, at least temporarily, shrinking some long-term battery capacity plans, and significantly stopping the development of next-gen hydrogen fuel cells. They're essentially clearing the books of what wasn't working or wasn't going to work soon enough.
Well, decisively closing some doors. And the other part, the remaining $400 million, that was a cash hit.
Exactly. That $400 million is cash charges for supplier contract cancellation costs. That's literally the cost of tearing up contracts prematurely.
Ouch.
Yeah, it's a sign of how quickly that market shift really forced their hand. They also halted BrightDrop electric van production up at the Salmon Assembly plant, cited the slow development of the commercial electric van market. I mean, that's a massive capacity rollback, all driven by slowing demand.
But they haven't completely abandoned the EV goal, have they? They still talk about it as the future.
Oh, not at all. EVs definitely remain their ultimate long-term vision, their North Star, as they call it. But the immediate goal now, it's to reduce the EV losses in 2026 and beyond. And they plan to do that by acting swiftly and decisively to address overcapacity, their words, and building strictly to actual demand rather than just, regulatory projections or hopes.
Build what people are actually buying.
Pretty much. They're still committed to future investment in things that drive profitability, like new battery chemistries. They mention LMR, which promises better range and cost efficiency, and also architectural improvements for the EVs themselves. And the retail portfolio, the cars you can buy, that remains unchanged. Products like the Chevy Equinox EV, which they noted is the best-selling non-Tesla EV, and the Cadillac Escalade IQ, those are still seen as strong products.
So they're right-sizing the capacity, not abandoning the technology itself.
Exactly. That's the key distinction.
Okay, so the company just took this massive billion-plus-dollar hit to correct the EV business. But where does the profit come from to, first, fund that massive course correction, and second, still raise guidance for the whole year?
Yeah.
It has to be the legacy side, right? The source material explicitly says, it is clear that ICE volumes will remain higher for longer.
This is GM playing to its absolute core strength, its bread and butter. The full-size franchises, trucks, and SUVs, these things are profit machines. They are just dominating the U.S. truck market right now, leading the industry with 41% year-to-date full-size pickup market share.
41%, that's huge.
It's massive. And get this. They are on track to lead full-size SUV sales for the 51st consecutive year.
51 years.
51 years, commanding a 60% year-to-date share in that segment. It's incredible dominance.
And their capital allocation, where they're putting their money,
Right.
It reflects this commitment, right? They announced over $4 billion in total capital investments earlier this year, specifically to onshore production, Tennessee, Kansas, Michigan, strengthening that American footprint.
Yeah, and the specifics here really confirm that higher for longer strategy beautifully. I mean, look at the capital going into the combustion engine. They're investing nearly $1 billion toward building a whole new generation of advanced, fuel-efficient V8 engines in New York.
Wow. Just stop and think about that for a second. In a world that seems obsessed with net zero, with rapid electrification, GM is essentially doubling down on the V8 engine, the sound, the power.
Mm-hmm.
That's a profound bet on consumer preference, maybe over regulatory pressure, and it's a huge strategic statement.
It absolutely is. And that leads right back to the repurposing of that Orion assembly plant we talked about.
Yeah.
After its temporary EV pivot, it's going to come back online in early 2027. And what's it going to produce? The highly profitable Cadillac Escalade and then their next generation full-size light-duty pickup trucks.
The core moneymakers.
Exactly. That whole plan is centered around using those high-margin ICE vehicles to generate the overwhelming cash flow they need to fund the eventual electric future whenever that fully arrives at scale. The overall goal, they said, is to produce more than 2 million vehicles per year in the U.S. once all these footprint changes are completed.
Okay, so the V8 is basically bankrolling the transition. Makes sense. But even this incredibly profitable core business isn't immune, right? It's exposed to global headwinds, specifically tariffs, which are shaving billions off that potential profitability. Their gross tariff exposure for 2025 was high, though you mentioned it improved slightly to $3.5 billion to $4.5 billion range.
Yeah, the trade environment is clearly an ongoing and expensive challenge for them. That slight improvement you mentioned, it was partially aided by the administration expanding the MSRP tariff offset program, which essentially gives them a little more flexibility on how they account for tariffs, kind of slightly reducing the immediate financial drag on the books.
Okay, that's helpful, but they can't just rely on, external relief or accounting changes. What are they doing internally? What are their mitigation strategies?
Well, they expect to offset around 35% of that gross tariff impact through specific self-help initiatives. They categorize them into three main buckets. First is discipline around go-to-market and pricing.
Mhm.
They expect modest, disciplined price increases year over year, maybe 0.5% to 1%.
Okay.
Second is those footprint changes we just discussed, onshoring production, maximizing factory utilization. Though it's important to note, the major benefits of those big capital investments won't really hit the bottom line until late 2026 or early 2027.
Okay, so the real relief from those factory changes is still what, almost 2 years away? What's the third bucket then?
Fixed cost discipline, just
Yeah.
tightening the belt across the board. Management indicated they expect these three efforts, combined pricing, footprint, and cost cuts, to make the net tariff burden lower in 2026 than it was in 2025.
Even with a full year of exposure.
Even though they'll have to account for a full extra quarter of exposure next year. Yeah. However, they did throw in a warning. The supply chain remains fragile. They specifically mention they're actively monitoring the very fluid supply of certain chips coming out of China, which, has the potential to impact production if conditions over there deteriorate. So still some risk.
Always risks.
Mm.
Okay, now let's talk about what might be the true future profit engine, something that sits kind of outside of whether the motor is electric or combustion. Software and services. Things like OnStar, Super Cruise. These are viewed as the essential path to high-margin revenue, both during the sale and critically after each vehicle sale.
Oh, absolutely. This segment provides the kind of profitability that traditional car manufacturing, frankly, can only dream of. They recognized nearly $2 billion in revenue just year to date from software and services, but you really need to look at the growth lever here.
Yeah.
Deferred revenue.
Hmm.
That represents future guaranteed bookings, basically money they will receive. That figure was nearly $5 billion, and it jumped 14% just from Q2 to Q3 this year. That shows significant future uptake, customers signing on.
Yeah, that deferred revenue number really is the gold mine, isn't it? And the subscriber numbers themselves are growing fast, too. Over 11 million OnStar global subscribers now. And Super Cruise, the hands-free driving system, has more than 500,000 active subscribers. That nearly doubled year over year.
And this is exactly why the strategy is so focused here. GM expects robust double-digit revenue growth from these services right through the end of the decade, with gross margins of approximately 70%.
70%.
70% margin. That is just a transformative economic driver compared to the, single-digit margins you often see in vehicle assembly itself.
And the technology, particularly Super Cruise, seems reliable. That's critical for consumer trust, right?
Yeah.
They highlighted something like 700 million hands-free miles logged.
With 0 reported crashes attributed to the technology itself. Yeah, that safety record is crucial.
And that confidence feeds directly into their broader autonomous strategy, doesn't it? How they see self-driving evolving.
It really does, and their strategy here is actually quite targeted. They're focused on achieving what they call personal autonomy, or PABI, at level 4 over time. So that means fully autonomous driving capabilities, but under specific conditions, and really focused on enhancing the experience for the individual driver or owner.
Not robotaxis.
Exactly. They explicitly stated they are not currently focused on the Rideshare 1.0 model or building and owning fleets of robotaxis. They see the future, at least for them, in providing premium autonomous technology for the vehicle owner, not necessarily becoming a mobility service provider themselves.
Okay, so let's try to synthesize this. What does this all mean for you, the person trying to understand where this massive company GM is actually heading?
Well, I think it means we really saw a blueprint today for how a legacy giant tries to survive radical, rapid change. So takeaway 1, financial agility. It allowed GM to raise guidance even while absorbing that huge but necessary operational charge to fix its EV overcapacity problem.
2, the strategic pivot is real. It's a forceful realignment back to maximizing the highly profitable core business, those big trucks and SUVs, while right-sizing their long-term EV goals to meet actual measured demand, not just hopes.
Got it.
And three, their ultimate profitability and maybe their future valuation relies very heavily on those high-margin digital services. OnStar, Super Cruise, future software, that provides the powerful financial cushion they absolutely need to navigate all this uncertainty.
Yeah, it really feels like a textbook example, maybe the example right now, of how a legacy industry player navigates these incredibly rapid, uncertain technological shifts and policy changes. They're leaning hard into their strongest asset, that profitable truck core, to fund the future, while simultaneously building up these high-margin ancillary revenue streams from software. It's a two-pronged approach. Which brings us right back to the heart of the strategic bet they're making. GM is betting really heavily that its next generation of full-size pickup trucks, the ones coming to that retooled Orion assembly plant starting in early 2027, that those trucks will generate enough stable cash, enough high margin, to fund the eventual sustained transition to their electric North Star vision whenever that market fully materializes.
Which I guess raises the final provocative thought we want to leave you with today. If they're doubling down so hard on that new V8 engine, on those massive truck investments, what happens to their long-term EV timeline if consumer demand for internal combustion for ICE vehicles remains significantly higher than even they forecast, well beyond 2027? Could that financial cushion from the truck business also become a kind of inertia generator, forcing them, or maybe tempting them, to further delay big capital deployment into their electric future?
That's the billion-dollar question, isn't it?
Definitely something to mull over as you watch those sales reports roll in over the next few years.